Okay, so I welcome you all for our meeting. And so far, we have been continuing with the very in-depth analysis of risk and return. And I won't be surprised if you say that you have done this theory before, because capital asset pricing model, or the CAPM, is a model that if you study any program in finance, you study almost in every course. I remember when I was a student in my master's in financial management, and I took 8 courses, and I think except 1 or 2 courses, which were basically quantitative finance, except them, it was explicitly discussed in each course. So popular is this model. CAPM, if I use the abbreviation, is used when it comes to putting a risk label on the securities. And if you want to do this labeling of the companies according to their riskiness, and also the minimum return which you expect from a certain investment, then this baseline or this bottom line or this the minimum sort of that what we should expect, not the minimum from the corporate from the treasury bonds, but what is the minimum you expect from the investment in the equity of a company. So those kind of decisions when you want to make, then CAPM can really help you tremendously. It's a very simple model, but it's widely used. Even the practitioners use quite a lot. A bit of history about it: Lintner, Trainer, Sharp, Mawson, these are the people who were the pioneer of this model. Then it was developed by Harry Markowitz. William Sharp later on received a Nobel Prize with Merton Miller and Harry Markowitz. And then this model has been quite much, getting on. And now the model has developed quite a lot, actually. So if you look at the modern version of CAPM, it's quite developed, but the key fundamental still remain the same. So the theory behind the capital asset pricing model, that it determine a baseline rate of return which an investor must expect from a certain investment in certain equity. So therefore, this solves many problems. So if, for example, being a corporate finance manager, you would be wondering, why would people invest in your company? Well, they would invest in your company because they are expecting a certain minimum return, okay? In the hindsight, retrospectively, when your company is old, 10 years, 20 years, you can think about it. Hey, in the last 20 years, we are having the shareholders in our company. Have we giving them more than the minimum they have been expecting from us? Or is it so that we are seeing a short, people are taking a lot of, they're doing shorting in the recent past, they're selling the stock. Is it a reason that what we deliver them is below what they are expecting from us? So CAPM can be a very good model to do the introspection as well. So whenever you want to see that, how have you met the expectations of your investors? Or have you fallen below their expectation? You haven't been able to meet their expectations from. So that way, even in the behavioral finance discipline, the initial dialogue always start with the capital asset pricing model. Okay. If you want to find the minimum cost of equity which your investors must get from you, otherwise they should find some alternative investment venture, is this very simple theorem, a very simple model equation. That is the risk-free rate plus beta, which I think we all know what it is. And And then we have this expected rate on return on the market index. And then you subtract the risk-free rate. And if you subtract the risk-free rate from the expected return from the index, this can also be called as a premium, the market risk premium, you can call it, times beta. And if you look at the inputs of CAPM, you will see that there's nothing much you can do about the risk-free rate. You can see from the central bank's website of the country. If you go to Swami Panki's website, you can see the 10 years bond rate. And I think, if I'm not wrong, last time I saw it was nearly 0.2%. Beta, I guess that you can see the headline beta, but I would recommend you that for this course and even for the future, if you want to make some cross-section analysis of the stock price movement, you should be having the skill of calculating the beta, which is the slope. Beta measure, it measures systematic risk. And then in one of the spreadsheet, which I have already shared with you, you can find out the annualized market return minus. So basically, if you look at the inputs, there is nothing which you don't know. Like any other theory, this model or this theory have also assumptions. We assume that all investors are risk averse by nature. To me, this assumption doesn't seem to be overly unrealistic, because I won't say that all the investors are risk averse, but if you make an analysis of the investors at the global level, then I would say that most of the investors are risk averse. Okay. Investors have the same time period to evaluate information? No. But if you look at task 3, I gave to all of you a certain same time period of evaluation. Investment is a very continuous process. People have different time windows of investing and disinvesting. So therefore, it will be not very appropriate to say that the investors have the same time frame or the same time horizon of investment. But in this course, if you look at task 3, we have the almost same time frame. There is unlimited capital to borrow at the risk-free rate of return. Well, only if you are a AAA company, only in that case it's possible. But even in that case, also there can be some hiccups. There can be some anomalies, because maybe you can do in a country or from a specific bank, but not at the international level, not at the global level. Investments can be divided into unlimited pieces and sizes. This assumption seems like an assumption that we study in microeconomics, which says that the goods are divisible, which is not true. When you buy shares, you buy in the form of stocks. Stocks means the bundle of shares, basically. So if you start buying piecewise each share, then we all know that the reality is that when you are buying the stocks from the agent or the broker, if you're a big company, there is a transaction cost. And this transaction cost could be enormous. So therefore, there is a, what is the word in economics? Yeah, there is an economies of scale. So actually, if you buy in bulk, your minimum transaction cost, so the baseline transaction cost goes down, basically. The average transaction cost goes down. But if you assume that you may not buy stocks, but the shares piecewise, then the transaction cost can be really prohibitory. So this assumption is almost I would never stand by this assumption. An even more heroic assumption is that there are no taxes, inflation, or transaction costs, which is very unrealistic. Unfortunately, we pay taxes. Okay. On a side note, even though these assumptions, most of them are pretty much unrealistic, but in defense of this theory or all the theories in the world, I would say that the assumptions are only a given, the ecosystem in which that theory is valid. So no researcher would ever say that my theory is universally applicable, because some of the assumptions would always be, difficult to meet. But that doesn't take away the credit from the theory. The theory is telling us a very important information, okay? And as there is a development in the literature, your theory develop, and one sign of theoretical development is that your assumptions become lesser and lesser, and most of the assumptions, they look real, not so unreal. So yeah, so don't get frightened. Don't get when you see these assumptions, don't start hating the model. Okay. So this is the security market line, which is a core phenomenon of capital asset pricing model, and you can see here that we always start with the risk-free rate, which is an intercept. I think I used this word last week when we were making it like a model, what do you call it? As the slope, the equation of straight line. I remember that model. And then we have this security market line, SML, and we are calculating beta, the measure of systematic risk, on the horizontal axis, and the expected return on the vertical axis. And you can see that when you calculate the expected return of the market, the beta is always 1, because market is a benchmark. So the benchmark is always 1. It can be 1, it can be 100%, whatever, but it's always a unit, basically. Okay. So, and because it's 1, so you can see that it's almost 45-degree angle, and that is why the slope is equal to 1, because the angle, if I make an angle here, if I pull this line down to the origin, I can say that I can very easily make a 45-degree angle. If beta is more, then the angle would be more. So hypothetically, the line would look like this. Okay, which means the slope is more. And if beta is less, then hypothetically, if I draw a line, beta would be something like this. So the angle would be smaller. Yeah, so this is the slope. So I don't want to, I think we discussed it before. I will not talk about the limitations again, because if you reverse, you can say that those assumptions which are difficult to meet are basically the limitations of the, yeah. Here I want to spend some time. The capital asset pricing model, it gives us a minimum equity return which the equity investors must expect. And if this is the base equation, the return on security J is equal to risk-free rate plus beta times the risk premium, RM minus RF. And if I just make some adjustments, if I put the RF terms together, then it become one term, and this become the second equation. So I'm just opening up the brackets, basically. And if I look at the regression equation, Regression equation, capital asset pricing model is calculating, once again, I'm saying, is the minimum rate of return which an investor must expect if they want to invest in your company. But what you actually deliver can be estimated by the OLS, the ordinary least square estimator, the bivariate linear regression model, which is this. And if you compare this equation, which underlines the minimum that you expect, and this equation which underline what you actually deliver, if you take the historic data, it looks that this and this term are same, so are this and this term. So then is what is left? Then alpha is comparable to this term, constant term. This is a constant. This is a constant. If you calculate that your alpha is more than this constant, then stock has done better than what was expected during the time. So for example, if this comes to be 5% and this comes to be 4%, it means that the stock has done better than expectation. And if both are equal accidentally, then the expectations are fully met. And if unfortunately your alpha is below than this equation, this term, it means that this is what was expected from you, 10%. This is what you delivered, 7%. And the difference is 3 minus 3. So your Jensen's alpha is -3. So the difference between these two sides is called Jensen's alpha. Okay. Yeah. But this is some additional information that we can also calculate, that how much coming from systematic, how much is the systematic risk and how much is the unsystematic risk. But I'll come back to this point. Here, the key conclusion is that the Jensen alpha is basically an indicator of expectation. Are expectation met, or are expectations not met? I want to give you an example, actually. And in fact, I want to give you the example from the spreadsheet. That will make things better. This is some kind of overly simplified example where the results are derived already. So I want to take you back to the spreadsheet. And if I'm not wrong, this spreadsheet is with you already. Where is it? Well, it should be in the spreadsheets. Yeah, I think if I can quickly share with you my screen. New share. This one, I guess. Yeah, I hope you can see. So this thing, the FINER return and risk, is something which you have already. But now I want to take you to this spreadsheet, and then we have some discussion about it. So I'm stopping the share thing for some time, and I need to check my spreadsheet. This. I have spreadsheets in so many different folders that sometimes it's very hard for me to. What is the name of the file? FINER return and risk. Okay, now I know where it is. FINER return and risk. Comprehensive analysis. I guess this is the file here. Yeah, this is a spreadsheet which I shared with you. this spreadsheet, actually, I have discussed with you I think in the last week, that you have the closing price. Basically, closing price is what we do with. Average price is irrelevant. So many of these actually columns I can reduce, I can eliminate, but I just showed it because this is how it would look like when you download the data. Volume, how many trades, turnover, the value of the trades, and how many transactions, how many times the stocks were exchanged on that day. For example, you can see that on a certain day, on 2nd March 2020, Finnair, no, on 3rd March actually, no, 28th February, there were a lot of trading, a lot of hands changed. But look at that in this day. What days? Yeah, 19th of February, the market was very lean on this day. So that also shows that how many trades took place. And then we derived the FinRet, the Finnair return, which we calculated. And because the daily return, nothing against it, but we are so used to of expressing the returns in the annualized manner. And then we calculated the annual return, okay? People differ in their approach. Some people say that we should add 365 days. Another group of schools say, which I belong to, who say that no, just take the number of days you have been trading. And I took 252 days because 252 days make 36 weeks, like divisible by 7. So that makes that on an average, there is a 36-week trading in a 52-week long year. And then we calculate the daily risk, and then we also annualize it. Okay. So in the same fashion, we take the index. Okay. Look, how you benchmark the stock return, what you benchmark against is also very important. So if you return will not change, the risk will not change, return will not change for a certain time period of the company, but the kind of index you're taking, that can also matter. So it could be possible. For example, if I take Finnair, I can compare it with OMX 25 Helsinki index. I can take Nordic All. I can compare it with Nordic Big Cap. So the kind of index I take will have impact on my results also. So I think we were having a discussion that why the beta and the other things that you calculate, why they differ from the headlines, what we read in Bloomberg or in Reuters or New York Times or these, Yahoo Finance and investing.com, these kind of popular platforms. One reason apart from many could be that the index they benchmark against can be different from what you have been taking. But if you're doing some cross-section analysis and you think that, hey, this index is a better index, it could be possible that you want to use the sector index, not the market index. First of all, there are several market index across the countries. Even in the same country, you can have the multiple indexes. And then you can, in certain stage, you want to compare, for example, BP or Shell with the other oil companies. So then you can take the oil index, or you can take some tech company index. So that is also very important when you make the analysis in your empirical research, that which kind of index you have been taking. Okay, so it depends upon your research questions, basically, what you want to do. All right, so then we take these kind of information. Yeah, remember you have to do some formatting also, because here you can see that there is a comma here, 4 point. But I made some adjustment that when I take my final column where I do most of the calculation, it's free from comma, because if I keep comma there, it would create some problem. So you should be you should be a little bit aware of these Excel settings, so that how you can get rid of these commas, etc. So once we have the closing price of the index, not the price, but the value, because index has a value, not the price. And then you can apply the same technique and calculate the index. And here you can find the average. So that this is the average daily market return. And here you annualize it. And same way you calculate the average daily risk. And then you annualize it. And here you see that you have your company vis-a-vis the index. Okay. Yeah. When you see these, this and this value, this and this value, do you find some anomaly here? Now, this was just out of curiosity that I wanted to calculate that for 1 unit level of risk, how much return you get. You can even say that to get 1 unit of risk, return to risk. So it's yeah, it's almost a double actually. Okay, yeah, approximately double, because even more than double, which is strange. So we calculate the beta here, which is the slope. And I put the notes, so make sure that you read them. For example, I wrote here that this beta, which you calculate, which you normally calculate, is called levered beta or equity beta. Why we call it levered beta or equity beta? Because this beta, this return, which you see of Finnair, is acknowledging the fact that Finnair is also having debt. So even though this is an indication of the closing price of for the equity investors, but this equity price is conditional or is affected to the fact that how much leverage the company has. Hypothetically, if Finnair was a zero debt company, no debt, means the company is unlevered, in that case, this closing price would have been different. Okay, so whenever you see the headline beta in some website, or whenever you are calculating the beta by yourself, this beta is incorporating the fact that the company has debt. Okay, but I'll come back to this thing later on. And then we have the yeah, we did calculate the total risk here. Okay, yeah, which is 33%. The reason is that there is a confusion. That is beta alone a measure of systematic risk? Well, you can say yes. But if you want to find out what percentage of systematic risk you have in the total risk, then you have to slightly modify the formula, and then you need to multiply the beta with the standard deviation of the index. So that would show what percentage of the market risk is coming due to what percentage of total risk is because of the market movement. So that's why we multiply beta with the standard deviation of market. And here we find that out of 33% something risk, the 5% is coming from the market, basically. So it means that the bulk of the risk which Finnair has faced based on its last 20 years performance on the year-to-year basis. It seems that the bulk of the risk has been the unsystematic risk, the firm risk, the specific, should we call it? Yeah, specific risk, yeah. Or diversifiable risk to the investor. So it means that the investors have a good situation who want to invest in Finnair, that they can minimize this risk by having a very effective, diversified portfolio. Then I checked that the average 10-year bond rate has been about 0.30% on a yearly basis. So this is also annual, but the 10-year. And here, very important, I want to bring you to the discussion that CAPM tells us the minimum return which the investor must expect from Finnair. And I use the CAPM model. So CAPM, which is RF risk-free rate, which is cell U21 plus beta, which is U16, multiplied by the risk premium, which is market return minus risk-free rate. And that comes out to be 1.790. So it means that the minimum return which Finnair investors have been expecting from it has been 1.790. Before I go further, I want to tell you, not a story, but I want to tell you some kind of illustration and I want to tell you this illustration or this anecdote or this hypothetical situation. It's not an anecdote, but it's more a hypothetical situation, which I often see in the classroom being a teacher. If I have a group of students, I always, like any other teacher, and I think your teachers would also agree with me, that when we observe the student in the classroom, their assignments, their participation, and all of those things, we have certain expectation from them. And let's say there is a student, particular student. I think that this student would get a grade of 2. Maybe I was not getting very much impressed by the student, and I know that this student will never get more than 2. That's here. And when I find this student's actual result, I find that the student has got 3. Oh, I was wrong. The student proved me wrong. But when I see the student's performance with the class average, the student has still disappointed because the class average is 3.5. I was expecting the student to get 2. The student got 3, but the class average is 3.5. Now here, I am comparing the performance of the student with the rest of, which is not so good. Compare the student with himself, the student job. What do you mean by performance? Well, this was my expectation. It was a latent, practical expected of the student. But the grade which he or she got is more. So there is a comparison between the theoretical performance of the student and the actual performance of the student. And here, when you compare this and this, there is an actual performance of the student with the class average performance. So you can have all kind of results. So when you have three variables, minimum return, expected return determined by CAPM, the actual return, and then the average market return. You have three variables. It means you can have how many? 1, 3, 2, 3, combination 2. So yeah, you can have three comparisons. So I can compare the student vis-a-vis the market, rest of the class. I can compare the student with his or her own expected performance. And the difference between the two, difference between your actual performance minus expected performance is called Jensen's alpha. So even though when I see Finnair's performance vis-a-vis the rest of the market, it's disappointing. But when I see this thing, then it's not so bad, actually, it's quite good. So it means that Finnair has met, rather overmet its investors' expectations. It is because we have the actual return, which we calculate by the model which I used, alpha plus beta market return. And then we have this CAPM return, which is the theoretical or expected. And the difference between them is Jensen's alpha. This could have been positive, this could have been negative. If it is negative, then you are going down investors' expectations. Okay, so here we can also learn a bit of Jensen alpha as well. All right, so we carry on our discussion, but because we now move away from the cost of capital, now we're going more towards the capital structure and how the capital structure can have an impact on the firm's value. So now we are going to, first we studied the fundamentals of capital structure or the firm financing, and then we did something about that, how we determine particularly we discussed the cost of equity. And now we are extending a discussion of capital structure with respect to the debt, the leverage, and how this can impact the company's value. Okay? By leverage, basically means that how much firm financing is done through the debt, basically. And debt, of course, is a vital component of capital structure or the firm financing. Yeah. If we carry on our discussion, if I just have a quick recap, we discussed the regression beta, and I think we had discussion about it quite extensively today. But the problem with the general problem with the beta is, even the conceptual problem with the beta is that we have some practical problems that we discussed in length today. But the conceptual problem with the beta is that the standard error is high. The standard error is that part of the relationship between dependent and independent variables, which are not explained by the independent variables. So because we are taking only one independent variable in the equation, so there is a very high likelihood that the standard error that we will find is very high in our OLS regression. The second problem, which is a major problem, is that the beta that we have been calculating, the return that we have been calculating, their decomposition is based on the historic analysis. So they are historic number. They are not futuristic. Of course, when you do this assignment and you make some inferences for the future, it would sound more futuristic then. But if you only stop at the calculation part and you don't go beyond that, then that looks very historic. It doesn't really show that, hey, what if the company has made some new changes, some latest business mix has been changed. The company has entered into some synergies. The company has made some $1 million investments recently. The company is going through a very strong restructuring process. So this is one more reason why I prefer that you guys should be calculating the beta by yourself rather than trusting the website or the headline beta, because that doesn't incorporate these changes, because that is so much aggregated that even though these changes are significant for the company's future, they will not be figuring very significantly in those statistics. So that is why, that's one more reason that if you want to make this calculation look more futuristic, because more recent past you include, more efficiently you can make some forecasting for the future. But if, for example, your beta, which you see on the website, is like a accumulated beta for the last 50 years data, then the very recent changes have the same weight as the number which was 50 years ago. So that doesn't really incorporate changes which are more current. So this is why I suggest to you that when you make these calculations in the exam based on these tasks, you should be doing this calculation by yourself. You should have your own data. You can pick and choose. You can do some cherry picking. Hey, I want to take this part. This was an unusual year because the whole market was under collapsation. So leave it out. That was an outlier. Okay, from this to this period was a time when the company was initiating a lot of restructuring process. Okay, find out the beta during that phase. Okay, so therefore, you have this inherent flexibility when you are calculating things by yourself. And one more limitation of the beta that you often see or you calculate is that this is the choice of index can be a problem. You are always in a catch-22 situation. Should I take the whole market index? Should I have the market cap based index, the large cap, medium cap, small cap, whichever is appropriate for you? Should you take any sector index or whatever, or the industry index? Okay, so these kind of things which are often troublesome for you. And I think when I was showing you the example of Finnair, I told you that I picked up an index, but maybe that is not the very appropriate index. Maybe I could have made a better choice. If we try to have a discussion about the beta, there can be several factors responsible for high or low beta. The nature of product or the service that you offer can also have an impact. Those companies whose cash flow is very cyclical in comparison to the more consistent cash flows, they are more likely to have a higher beta. I'm making a very strange kind of example that if there is a company which is producing, which is producing ice cream, only ice cream, or these, basically ice cream, let's put it this way. It should have a higher beta than a retail store where you have different type of products. Okay, because all else being equal, I can make some I can make some hypothesis that this ice cream making company's cash flow would be more profound during summertime, but maybe not during the wintertime. Same way, the luxury goods, they have a higher beta than the basic goods. When I see this point, it reminds me once again the high school microeconomics textbook, which says that there are three kind of products. One are the necessities or the essentials. And the essentials are those goods which we eat, we wear, we use to take shelter, no matter what the price is. If the food price become expensive, we don't stop eating food. But if the food price is low, we don't start eating more at the same time. So the price, and if we become rich, we don't start eating more. And if we become poor, we don't outrightly, stop eating. We make some adjustments in the consumption pattern. So in other words, the goods which are consumed by the masses, or the goods which have the low price, the basic goods, are generally the necessities. And they are less price and income elastic. There was a chapter in microeconomics called Price and Income Elasticity of Demand. Those goods which are less elastic are likely to have a lower beta. On the contrary, the luxuries. The luxuries are the goods. If there is a small drop in the price, suddenly people who think that, hey, this product is so luxurious and the price has gone down, and maybe this price fall will not remain forever. And once again, the price rise again, the good will be once again out of our reach. Let's buy it. It's a lifetime opportunity. And at the same time, if the price goes up, then you have no choice but to postpone it, because the product is so expensive that even a small incremental increase in the price can be quite a lot. You're buying some expensive yacht and the price goes up by 2%, it would be a big money. Okay? So generally, the goods which are luxurious, which are only haves kind of people who are rich, they are able to afford. They generally have the higher beta. On the contrary, the goods which are consumed by the masses, they have low beta. The goods which are consumed by masses have low beta, and the goods which are consumed by some certain classes, they have the higher beta, all else being equal. Example. I think I told you this example once, that I was looking at the Firstenergy company's beta. I didn't calculate, but I just saw because it was part of our project. The Firstenergy, the utility company, its beta was about 0.15 consistently. But on the other hand, I saw the Taylor Wimpey's, which makes this holiday home for the Hollywood actors, for the very rich football players in Dubai, in Bahamas, in all those exotic destinations, very posh. The beta was, I think, 2.75 or something, or maybe even more. Okay. And same way, the high-priced goods, I don't know why I have this separate point, even though it's connected with the previous one. Should have higher beta than low price good. I think there is some problem. Firm should have higher beta than the high price goods. Okay, I'll sort it out. But you know what I want to say, that the goods which have high price, generally they have high beta, and the goods which have low price, they have low beta. And this is my argument, hypothesis. Okay, empirical evidence could be something else. The growth firms have high beta generally because their cash flow is very uncertain. And they are entering in a venture which is very promising, but at the same time, the risk is huge. So if you compare the growth firms with the traditional firms, then you can see that the beta of the growth firm is generally higher than their other counterparts. Okay. Operating leverage. Operating leverage is something that we shall discuss today. And operating leverage is largely tied to the fixed cost as a percentage of total cost. We all know that in some companies, the fixed cost is a very big chunk of the total cost. In some companies, the variable cost is more prominent than the fixed cost. Look at the companies like I gave you example here, infrastructure requirements. Look at BP, Shell, these oil companies, these manufacturing firms, very factory-based kind of companies, the old-fashioned. You see that their infrastructure needs are enormous. But on the other hand, we have some very lean style companies, which are they're not providing any factory products, but they are providing some services, for example. So they might require lesser physical infrastructure. Okay, and their cost structure is more flexible. Perhaps they are not recruiting people, but they are selling the license to the others. So people are using their franchisee rather than only using their selling and their brand. Small companies may have than the larger firms because the small in the beginning, when they are in the stage of infancy, they might need to invest enormously in the infrastructure. And that can be very costly. But that infrastructure which they have is going to stay with the company for many years or maybe decades. So by the time company become big, large, that time the cost of infrastructure may go down, average cost. And so is with the young firm. So basically it's the same thing. So the beta, the cost, the fixed cost can change from a firm to firm, depending upon the institutional factors which are driving you. And operating leverage basically can be measured in many ways. But one way of measuring the operating leverage is that you can take the EBIT variability measure. We all know that EBIT is the interest and tax. Okay, it's a kind of net profit. So many call it net operating profit. EBITDA, earnings, tax, and amortization. Several people call it gross operating profit. Okay, but I have seen some textbooks where you can calculate it with the EBITDA as well. So as long as you are consistently doing it. And the variability measure of EBIT is that you take the percentage change in the EBIT and then you divide it by the percentage change in revenue. Okay, and if the measure is more than one, it means that you are able to convert more revenue into operating profit. And if you are able to convert more revenue into profit, it may mean that the fraction of the fixed cost in the total cost is lesser. On the other hand, if your this EBIT variability measure is below 1, it means that even though your revenue is increasing quite remarkably, your profit is rising, your operating profit is rising less. It is because you find it hard to absorb the revenue, the increased revenue into the fixed cost. So this is why, because it is about your cost, revenue, therefore we use the word operating leverage here. Not very difficult to calculate. One example I can give you is that it's a very old, I don't know, this is just a fictitious, I think I put this. They don't belong to any real data. So I created some fictitious years and the data. And then here I find the change. So you know how to calculate the change. So for example, 37.55% is the increase in year 1989 over 1988, the sales revenue. So we calculate in comparison to each year. So this is the increase in 91 over 90. This is the increase in 92 over 91, and so on and so forth. And because I had how many years? 11, I think, because including 88. So yeah. So then we find the average, and it comes to be, I don't know, it's 98 now. Yeah. So when I find the average, it comes out to be 32.58%. It means that on an average, the sales revenue has been increasing by 32.58% of this fictitious company on Y to Y, the year-to-year basis. And here I took the EBIT, the net operating profit, and this shows the increment over the previous year. And then I find the average of this whole column. It comes out to be 34.94%. And going by the formula, percentage change in EBIT divided by percentage change in the revenue. So when I go by this, it comes to be 1.07%. In other words, for every $1 increase in the revenue of the company, the net operating profit is increasing by $1.07. It means that the company is able to divert more part of increased revenue towards profitability because maybe its cost structure is lean, lesser of fixed cost, and relatively more of the lesser of the fixed cost and relatively more of the variable costs. Okay. So I would then there's a task 5. Once again, I don't ask you to send to me, but you can carry on with the company you have chosen already. It's good that you keep one company for all the wherever possible, keep the one company into consideration. So you can carry on with the same company, with the same firm, and take the last 5 years data, and which you can obtain because you need EBIT data and the sales. So both variables you can get from the income statement of the company. Okay, if you take last 3, 4, 5 years, well, 3 is not enough. Maybe 4 or 5 is good because then you can have more better average, and then you can find out that if your company's operating leverage is more than 1, which is a yardstick of increased performance, or is it low? So this you can try by yourself in task 5. Is the financial leverage. And the financial leverage, basically, we were discussing, if you remember, when I was showing you the Finnair comprehensive spreadsheet. There was one section which I didn't touch. I said that I would discuss with you, but I discussed one thing with you, that when you are calculating the beta the way we did today or before, or whether you see the headline beta from some external source, that beta is called equity beta because that is calculated on the stock return, the equity return of the company. And that is called the levered beta also. Levered beta we call because the companies generally borrow. Very few companies, they have zero borrowing. And borrowing, the fluctuation in the borrowing, so if the leverage of the company changes, that will have impact on the company's stock price, and the stock price will have impact on the stock return. So therefore, the beta which you often calculate, or the beta which you often see on the web page, can be called in more academic terms as equity beta or the levered beta. This is a real beta. This is normally you see, 99.9%, I would say, companies do borrow. Who doesn't borrow? Unlevered beta is a phenomenon which is based on what if analysis. What if analysis? Okay, now see in this context. What if the company doesn't borrow at all? What if the company doesn't borrow at all? No borrowing. How much would be its beta? What would its beta look like? This inquisitiveness, this itch in the head that, hey, let's check the company's beta. Theoretical, hypothetical, latent. That what if this company doesn't borrow at all? And all the debt is basically equity. So there is no debt, zero debt. What would be its beta looking like? That is called unlevered beta. It's a fictitious, is a notional thing, is a hypothetical thing. And the way we calculate the unlevered beta is that we have the levered beta as such. We divide levered beta with this 1 plus 1 minus corporate tax rate. Remember that tax is an important component of your finance cost. Sorry. The corporate tax rate is very important component in your financing discussion because we know, hopefully you all know that the tax is not falling on the finance cost, the interest, but the corporate tax falls more on dividends, the share of profits that goes to the shareholders. But when you look at the income statement, you always see that the interest/finance costs are always paid before the company is paying, not paying, but sharing the profit to its shareholders. It means that when you want to have a discussion about levered and unlevered, an important component is the corporate tax rate. So we include it in the formula, and then we multiply with the debt to equity ratio. Debt to equity ratio shows that what percentage of debt and we have in the company for a certain level of equity. So when you include these, this denominator, okay. Now hypothetically, you imagine that the company is having no debt. Just hypothetically, like Microsoft didn't have any debt, almost zero debt. I remember in 2000, I was analyzing it when I was studying about 1999, 2098. That was a time when Microsoft didn't have any debt. I checked by myself, zero current debt, 0 non-current debt. In that situation, your debt is 0. Because debt is 0, then this whole term becomes 0. And what you have? Levered beta divided by 1. It means that in that situation, your unlevered beta and levered beta would be same. But as I said, that generally, the companies do have debt. Because they have debt, therefore the tax man treat them differently. Okay. Therefore, the unlevered beta and the levered beta would be different. Okay. I have an example here. By the way, because we talk about in finance, we have so many synonyms. Like levered beta can be called as equity beta, or what was the other name? Equity beta. Yeah, levered beta and equity beta. Yeah, this the normal beta that is. And the unlevered beta can also be called as an asset beta. Asset. Okay, as an asset beta. And yeah, this is something business risk beta, but that's not a problem. I want to take you back to the spreadsheet. And then I will discuss with you that how this levered and unlevered thing comes in discussion. So I stopped sharing the, even though your task is that you have the levered beta of the company and calculate the unlevered beta, which shouldn't be a problem after you see the spreadsheet. So I take you to the spreadsheet once again. And now I share it with you. We had discussion. We stopped a discussion here, actually. We stopped a discussion, the Jensen Alpha, that the company, even though has underperformed in comparison to the benchmark, in comparison to the index, sorry, not index, yeah. The company did quite good job in terms of its own expectations attached to the investors. Okay. Now we carry on this debate further, this narrative further. Here, I include debt and equity, which is I took only for the latest year. I don't know, I've forgotten because I made this calculation last year, so maybe it was 2018 or 19. Okay. Debt was this much, the equity was this much. So in other words, the company was highly levered, 1.88 is massive. And by the way, more levered you are, there'll be big difference. The difference would be between the levered and unlevered beta, because we just saw in the notations in the formula that if the debt is 0, it means that the debt to equity ratio is 0, then there is no difference between levered and unlevered beta. But if the debt to equity ratio becomes more and more prominent, more significant difference would be between levered and unlevered beta. And here 1.88 is a big leverage ratio. Okay, and then we have the profit before tax. It was 188.6 million euros, I think. Yeah, but anyways, the corporate tax rate was 37.9. The profit after tax was this, and here I calculate the effective tax rate, the tax percentage which company paid. Don't take the tax rate. If you Google corporate tax rate in Finland, it could be any number, but that doesn't mean that each company is paying the same tax rate. So I calculate here effective tax rate, which company has paid, which is the ratio of the tax you pay and the profit before tax. So this is the corporate tax rate. Okay, and this is D2E. These are the only two things we need, nothing else. And when I put them in the formula, levered beta 1.88 divide by bracket starts 1 plus the inner bracket starts 1 minus U33, and U33 is your effective tax rate, times U29, which is the leverage ratio, debt to equity. And we find that if Finnair had no debt, then its beta would have been close to 0, basically. So you can see that the beta with debt is this, and the beta with this without debt is. So when the company in reality is levered, the beta is this. But when the company imaginarily zero debt, then the unlevered or asset beta would be 0.09, so close to 0, basically. So nearly no systematic risk. Okay. And this is the last thing which I will not discuss today. I will discuss only the difference between, even though it's only one calculation, but I will not discuss today because the concept is very, very important. It requires discussion. So you can see here, beta with debt, beta without debt. And all you need, this is real, this is what if there is no debt. And the difference is made by basically the debt to equity ratio, which is huge. More the debt to equity ratio, more difference would be between the levered and unlevered beta. More tax you pay, higher the fraction of tax you pay, more difference would be between levered and unlevered beta. Okay, so just imagine that you are living in a country where the effective tax rate is very less, close to 2%, 3%. Then this difference would be, will it be more or less? Because if you have more tax, then 1 minus U3 will be small. Small denominator means, and when you add 1 plus, okay, so then the gap would be less. But if you have, so I think if you have more tax rate, then the gap between the levered and unlevered beta would be more profound in comparison to a country where the tax rate are lower. Okay, so basically this is all we need to discuss today. We discussed many different things. We discussed about the whole idea of this limitations of beta measure. We discussed about this two-way comparison, and then we discussed about Jensen's alpha, which is, with the help of Finnair example. We discussed about that how the leverage would have impact on the firm's value. And for this purpose, we went to two types of beta. We have the leverage, operating leverage. And then secondly, we discussed about we made two categories of beta, the equity beta or the levered beta, and then which is real because it incorporates debt. And then we have a hypothetical beta called unlevered beta or asset beta, which assumes that the company is debt-less. Okay, we will carry on this discussion from this point next week. Thank you so much.